All right, attendance is building, so we're going to have a great one for you today. We're going to be talking about strategies for success as a farmland investor in any economy, and particularly in what might be a downward trending ag economy. And we got not only a special guest, David Martin, but we've also got Robert Halderman's on the call here. I feel like honored, man. We brought up the old guard. Anyway, so we'll get going here live in just about 30 seconds. And Emma, you want to take care of that? We got somebody else on their camera that we don't need. All right, we'll get started in about 30 seconds. I think Emma wants to get rid of that person. Emma, I think we got somebody on the camera that we don't need right now. Okay, you got it. Cool, thanks. All right, hey, remember, you can watch these recordings if you can't be here live. This is the continuation of the series, Maximizing Your Farmland Investment. Great thing that is done here by the good folks at Halderman Real Estate Farm Management, Farm Management Real Estate Appraisal. Anyway, you know who they are. They're the go-to resource. We've got a great one for you today because we're talking about how to succeed with your farmland investment and the strategies to do so in a downward trending ag economy. We know that ag is cyclical. It doesn't mean that you can't still prosper and make good decisions that can help you for your long-term physical investment, which is your farmland. We always start off with a big market update from Howard Haldeman. But before we do that, we always introduce our special guest. We've got David Martin. He is with a company called U.S. Agriculture, and he's going to explain to you what U.S. Agriculture is, what it does, and the level of expertise he's going to bring you. Occasionally is going to be a touch overwhelming because it's so vast, but it's really, really good. And remember, you can always ask questions. One of the cool things about these webinars is we have the chat feature. You go to the bottom with your cursor, you type in your question, and we will make sure that your questions are addressed. The interactive aspect of these webinars is what makes it so valuable to attend live. Yes, you can watch the replays at the Halderman website, but being here live allows you to be interactive. Mr. Martin, 1992 graduate from Purdue University, bachelor's in agricultural economics. He and I were in the same classes, and I don't have any idea who he was. But anyway, that happens. Mr. Martin, what's going on? Who are you? What do you do? What does U.S. Agriculture do? Yeah, turn your microphone on. Your microphone is off. Turn your microphone on. There we go.
I got it. Thank you, Damien. And I do remember you at Purdue. I just, the memories are so wild that we probably can't talk about them today. Hey, I'm the managing director for U.S. Agriculture. We're a Midwest-based farmland advisor and manager for institutional capital. We operate throughout the United States from the West Coast to the East Coast. Today, we're specifically working in 14 different states and have over 65,000 acres under management. The background on the business, Howard actually began this back in the mid-2000s. He saw that vision that there'd be a day that institutional capital, state pension plans, and endowments would have interest in this asset class. And so we started this business back in 2011 and have grown it since then, and looking forward to today's discussion.
We appreciate being here. And remember, this is an institutional investment sort of an organization. They take money, vast amounts of money, family offices, pension funds, whatever, and deploy them. And you're saying, wait a minute, I'm not sure I do that. I own 380 acres in Illinois. Doesn't matter. Principles and strategies have a lot of crossover. You're talking about a different comma in the dollar amount, but that does not matter. Remember, you can listen to Warren Buffett and learn a hell of a lot about how to smartly invest your money. And trust you me, nobody in this webinar is ever going to have the amount of money to invest that Warren Buffett does. It doesn't change the strategies, nor the discipline, nor the shall we say, practices. So that's why we got Mr. Martin on here. All right, we're going to get into the market update. It's a slower time of the year. This is Q2, approaching Q3. Generally, these are the slow times. If you're in the real estate, marketing, agricultural, farm auctioning business, it's slower, but that also means we've come off of the spring. So from then to now, Howard has some really good numbers, and I think you're going to hear them. So what do we got? From March till now, what's changed?
Not much in terms of farmland values, at least in the Eastern Corn Belt, Damien. Welcome everyone today. On behalf of the Halderman Companies, glad you're joining us. We always look forward to these webinars and hopefully can provide you some insight. In today's case, it's farmland investing. And Damien's exactly right. What David's going to talk about here in a few minutes whether you're investing millions of dollars or hundreds of thousands of dollars, the principles are the same. I am confident the amount of money you might want to put in farmland or you have invested in farmland is significant to you. And that's really all that matters. How you invest that money and how you want it deployed is important to you. And it doesn't matter if it's 500,000, a million, or $10 million. They're all very important, and we manage those assets as such. So let's talk about the farmland market. It's been interesting the past couple of months since we did our last seminar. I think that was in April. We have seen a thinly traded market in the Eastern Corn Belt. Very few farm sales, which would be normal. Once you start planting the crop, a lot of things kind of shut down. We had 0 auctions in May, a couple private transactions, certainly, but did not have any scheduled auctions in May. We've had a few in June. Most of them have not been farmland pieces that would qualify for what I would call a WAPI chart comparison. But in spite of that, I'm going to share my screen here real quick, and I will show you the current WAPI chart that we have here at Halderman. You'll look at the 25 chart. This is every sale that qualifies. Again, as a reminder, it has to be at 90% cropland or more. Has to be a transaction that doesn't include a lot of improvements, silos, houses, confinement buildings, those sorts of things.
Howard,
so
real quickly,
yes,
quickly, we did this at least 2 different times, but always remembering that the viewer of this that can't ask the question, or even the person that is on here live, might say, remind me again of what WAPI is, because this is the best tool that I think you've come up with. Remember, all land is not created equally. There is difference between productivity features and whatnot. So if the person that's just tuning into this is their first webinar, WAPI stands for
Weighted Average Productivity Index. And so every soil in Indiana, Ohio, Michigan, Ohio, and Illinois are all basically scored. And Purdue, in the case of Indiana, Purdue University and the USDA, United States Department of Agriculture, have combined together to say, hey, Rensselaer soil types are rated at 165 bushels per acre of corn. Likewise, you get that for every soil type. And the beauty of that is then we can look at a farm and you come up with an average productivity index for that specific farm. And we take the sale price of a farm that we have sold and divide it by the productivity index, the average for that specific farm. And we come up with so many dollars per corn bushel of productivity index. And so that's the dollars per WAPI. And in this case, you're looking at a chart from 2025 sales. The red line is the trend line. The blue line is individual sales. And you can see individual sales are all over the board. That's pretty normal. Farms tend to be very unique. They all have special attributes, different drainage, irrigated or non-irrigated. Location is a huge factor, of course. So the trend line is really what we kind of focus on, because that tends to be the long-term average, and that smooths out the idiosyncrasies that you see farm by farm. So what's interesting is 2025, if you look at that chart, and I said earlier, Damien, not much has changed. We've been in a pretty stable market. We had a tremendous sale, well over $120 per bushel. Probably an appraiser is going to look at that and say, yeah, that's an anomaly because it's so much out of the marketplace. Mm-hmm. We had a couple of weaker sales back there when Liberation Day was coming up. And you can see that right at the end of Q1 in late March. Maybe a little weaker through there. And then, after the tariffs were announced and then they were, kind of retracted, you see maybe a little bit of strength coming back. But on the average, the year has been pretty strong. So the next chart, it will show, I'm not moving over. There we go. The next chart shows 24 and 25, and you can see a slight uptrend to that red line. That shows the strength, and really then go to this chart, because what's interesting, 2025's average as of up to the minute, because I did this calculation this morning, we're at $86.67 per corn bushel of productivity index. That is about 19 cents per bushel higher than we were in 2022. Now, Damien, you asked me beforehand, real or nominal? These are nominal numbers. So we haven't adjusted for inflation. If you put an inflation factor on that, certainly today's values are below what they were in 2022. But on just the highline average per acre, we are slightly above. So what that tells me is you can see 23, 24, 25, a slight increase. Indiana, Ohio, Michigan sales largely make up these. Those are Eastern Corn Belt states. David's going to talk about a more global discussion, not global, but across the continental 48 states, a much larger marketplace. But at least in the Eastern Corn Belt, we continue to see decent strength in land values. I think the Chicago Fed, the Illinois survey, the Iowa survey, they would suggest those states west of here have experienced a slight decline, and maybe 3%, maybe 5% off the high from 2022. So I think there are some declines in the Western Corn Belt. They've had a little more challenges with crops the last couple of years, where the Eastern Corn Belt's been a little stronger. Honestly, the other factor in the Eastern Corn Belt is the halo effect from the other industries and economies that exist in Indiana, Ohio, and Michigan.
And population. You talked about in our April webinar that, if you want to look at highest and best use, and everybody on here is a tuned in real estate investor. And I thought you made a really good point in the April webinar that while there's amazing prairie soils in much of Iowa, goodness knows I go there for my speaking trips, there's also not the population density and then therefore the developmental pressure. And that does absolutely affect these numbers. Yes?
Absolutely. I think if everybody's heard the old saying, the value of real estate is location, location, location. And that is 100% true. And when you have data centers, when you have large tracts of land being purchased in the state of Ohio for a large Intel plant, or the IEDC, Indiana Economic Development Corporation, is buying land down by Lebanon here in Indiana, then that creates 1031 exchanges that get reinvested in farmland. And typically those land sellers want to buy relatively close to home, which then drives up the values here in Indiana. One last chart that I thought might be interesting to folks is this share of farmland sold. You can see the percentages on the far left. You can see the colored lines indicate various states. For whatever reason, this is Iowa, Illinois, Indiana. So the 3 I states plus Minnesota. That's not Michigan, that's Minnesota, and then Ohio. What I found interesting about this, Damien, is this is the percentage of farmland sold of the whole marketplace. Indiana's green. Indiana tends to be one of the more thinly traded states. I think this last year was 1.25% of the farmland sold was sold. Mm-hmm. That's below Illinois at 1.8, well below Ohio, which Ohio's up at 2.25. And you'd say, well, gosh, those aren't that far apart, Howard. But you're talking almost 100% different in volume of transactions between Indiana and Ohio, or Indiana and Minnesota.
I love it. The three of us are economics-minded people because of our degrees and our training or whatever, and obviously what you two do for a living. I think it's always important to point this out. When we talk about something is at 1 point, you said 1.25 to 1.5, and the other one's at 2 point. The normal way to think of that is, oh, that's only 1% difference. No, the difference between 1.5 and 3% is 100% difference in terms of the numbers of farms. And that's, I think, an important distinction. So if 10,000 farm properties sold, you're talking about in one place, and it could have been double that in another place, right? That's really what we're talking about. It's a 100% difference between 1 and 2% at this level, and that's a hell of a lot of farms.
Yeah, I think that's a material difference. I also thought this was very interesting. Iowa's the blue line, and it's below 1%. And, I think about why, and our business is not based in Iowa. We don't do much in Iowa historically. It is a very farmer ownership based state, yep. And farmers tend to not sell. Illinois, by contrast, has a lot more investor interest. And of course, Illinois doesn't have foreign ownership restrictions. Iowa does. Now you'd say, oh, that's the reason. No, it's not. Minnesota has foreign ownership restrictions too, and they're leading the pack. So it isn't that. But I just found that interesting. Iowa's at the bottom, but Indiana surprised me as low as we were on the transactional volume versus Ohio.
On that comparative, and this is going to be, I'm sure you can pull the numbers, but it's somewhere between comparative, actual empirical data, and then anecdotal data. When you look at the different states, Howard, since some of the people that are watching this live and that tune into it are more the pure investor or from a farm but don't farm anymore, which states that when you think of, like you said, Iowa is a farmer owner culture, if you want to use that word, is Minnesota with pushing out that for is there more transactions because Minnesota really is more investor owned? There has to be some sort of relationship between that. So which state, when you think of Indiana, seems pretty open to investor ownership, and obviously David's going to talk about that. Just kind of talk about the difference in states and the amount of investor owned.
Yeah, I think the percentage of absentee owned land, which would be investor owned land, is higher in the Eastern Corn Belt than it is in the West. That historically has been the case. So where Indiana might be at 70% today, Iowa's probably closer to 60.
Of the absentee / investor owned.
Yes, that's still a high percentage. But keep in mind who those investors are. Those are folks that have retired off the farm, this generation or the previous generation, and they're keeping it because the odds are they still live there, have family members that live there, and they rent it to extended family or neighbors. Yeah. So it's absentee owned, but absentee only by virtue of the fact that it's still a family that owns farmland and they rent it to the neighbor down the road. I don't know. I don't think that explains the difference between Minnesota volume and Ohio volume. Ohio is going to be more absentee owned land than Minnesota. I'm pretty confident of that. Yep. Yet they got similar volume characteristics.
Yeah, so there is a correlation between investor owned and percentage of transaction annually, because an investor isn't operating it or has a few less heartstrings attached to it. But that's not what happened. What do you think it is in Minnesota?
I don't know. David, do you have any thoughts on that? I honestly don't know why it would be double Indiana's.
I'm like you. I'm probably at a not quite sure why that would be like that, because
just an anomaly. Yeah. It just happened to be that it was the year that I don't know, a lot of
and maybe, Damian, it's price appreciation, and they're looking at it and saying, historically speaking, Minnesota had weather impacts that we grow shorter season corn. Even though we have climate change and things are warming up there, I think there's historical knowledge of saying, gosh, we're at values in Minnesota we never ever dreamed. I would argue that we have the same situation in Indiana, but maybe there's a little more. We think there's more upside in Indiana and Minnesota. I don't know.
Could be that, like the shock effect of, oh my goodness, whoever thought we'd have this much money offered to us for this land, move it, sell it. So that's like the sticker shock, inverse of the sticker shock kind of thing, I guess.
Right. So the last topic I really want to discuss was rents, Damian, and then we'll switch over to David. Some statistics I found very interesting. So when you think about farmland rents, we're talking cash rents. So many dollars per acre per year that the farmer's paying the absentee landowner to rent the farm. The Chicago Fed, which is Indiana, Illinois, Iowa, Wisconsin, and Michigan, those 5 states. The Chicago Fed said rents from 24 to 25 were down 2%. Okay, that kind of makes sense. Farm economics are not as good in 25 as they were in 23. And so maybe a little bit of a downward trend is 100% in line. Illinois was down 2%. Iowa was down 3%. Indiana was actually up 1%. Now you'd say, well, why would that be? I think largely Indiana, from a rental market standpoint, tends to lag Illinois and Iowa. Illinois and Iowa will have more, I think, Indiana would have 0 counties that average $400 an acre. And I think Iowa has 6 counties, Damian, that average over $500 an acre, or not average, but are at $500 an acre, have rents that high. And there's 30 some counties that have $400 an acre. Indiana doesn't have that. So I think we kind of lag those 2 states in getting there. So maybe we're still seeing a 1% incline due to that. So I found that a little bit, if you're the farmer listening to this, you're like, okay, that sounds reasonable to me. Maybe rents are coming down a little bit. But here's the other thing. I've mentioned in some of our seminars when I show the Purdue land value chart, and it's a hockey stick move up the last 4 or 5 years with inflation and farmland going up 40%. And then I say, remember this chart, because when we look at the rental chart, it doesn't look the same. And those of you that have seen that chart, it kind of goes up and it gets to about where we were in 2013 and it comes off. So in Iowa, the survey that they did this spring, the average rent in the state of Iowa was $271 per acre. And they said that was down 3% from 2024, which is exactly what the Chicago Fed said Iowa was down 3%. Okay. $271 an acre, Damien, is $1 higher than the average rent in Iowa in 2013. Not 2023,
right?
12 years ago in 2013. So when you think about the inflation that we've experienced in farmland values, the appreciation, inflation is probably an unfair term there, but it's really the appreciation in it. We haven't seen that in the rents. So what that means is landowner is receiving a lower percent return on their investment. And certainly if you adjust for inflation, they're well below where they were in 2013 from a financial return standpoint. So I think David's going to talk about where they look at investing, where US Ag looks at investing across the country. And honestly, I think what he'll tell you is the last couple, 3-4 years, we have not bought a lot of land here in the Midwest because cap rates have really gotten pretty skinny, and especially compared to other financial instruments, and we can get higher returns on other crops in other parts of the country. So I just thought that was interesting. Certainly the farmer, I'm sure they don't feel like they're paying less rent. Feel is the key word there. I'm sure they're still feeling the pinch because all the other inputs have appreciated at a very high rate, but land really hasn't. And this kind of documented that.
So it's interesting because if the coffee shop crowd or the old country elevator crowd, they would still be carrying on that rent is too high. And you can absolutely make the case that from a historical standpoint, you're paying $1 more than you were on something that the investor is in for roughly double the amount that they would have been in 12 years ago. That's really what it comes down to. And,
exactly.
And if it were an apartment building, a shopping center, that would not be the case. You're not going to end up having an acquisition price that then still has the same rent as it did at half the acquisition price 12 years ago.
Right.
Which then leads us into our friend David Martin, who's going to tell us why this all makes sense or doesn't make sense, because he's got pools of tens of millions of dollars. Actually, I don't know if he's allowed to tell us how much that he's investing for the companies that and the institutions, I should say, that put money in there. And I was kidding when I said I didn't remember him from 1992. Actually, I think when you look at vintages, like, fine wines, I'd say 92, probably some of the most brilliant people ever cranked out of there. I mean, I still do gigs for some of these people, David. I mean, it's just, some classes just stand above others, right?
I so much agree with what you're saying. I might even start pushing for a statue that for you at the front of Purdue University. That probably is coming.
Well, I'm not sure that that's something they'll. I think you have to be a donor to get a statue down there. Anyway, and I donated plenty back when I didn't have a lot to donate. Anyway, let's talk about, speaking of donating, I could make the case based on what Mr. Halderman just said. It's foolish to be a buyer of agricultural real estate right now because my rent rate is only $1, which on a percentage basis is a fraction of 0.5% is what you're talking about, different than it would have been 12 years ago. And I'm paying double the amount for the asset. I can't justify this.
And, in the state of Iowa, I don't know that that's right or wrong. What we bring, the service that we offer at U.S. Agriculture is to build diversified portfolios of U.S. farmland assets. And, what does that mean? Why is it important? What that means is trying to be, if you can think of the United States and draw a smile from Washington State down through and up into the East Coast, it's trying to build a portfolio for a large institution, and we do. We deal in millions. We're approaching 700 million of assets under management, and so in a year we're looking at approaching $2 billion of farmland assets to just evaluate whether they're institutional grade and we end up purchasing around 50 to 75 million of farmland annually.
Okay, so those are real good numbers, and the reason we're not doing this to brag, we're just doing this for, I think it gives a real good picture of the breadth of what you see, and therefore, remember, if I only ever know what happens out my door in this township, I don't have a lot of exposure and frame of reference. You're buying 50 to 75 million dollars worth of agricultural investment real estate in an annual basis, and with $700 million that you manage actively. Your base is pretty darn good when you've got that sort of, and it's in how many states?
14 states.
14 states. Thank you. Okay. So I just said, I make the case that I don't know that farmland's a good investment right now based on the numbers and the returns.
Yeah. Yep. And let me make the case of why. For institutions, they typically are invested 60% in equities, 40% in bonds would be the general allocation of a large state public pension. And keep in mind, these public pensions many times are trying to allocate billions, 5 to $200 billion into assets that will give them some type of real return. And if you go back to 2008 and look at the volatility in the stock market, in the commercial real estate market at that time, in the debt markets in that time, I think the institutional world came back and said, hey, we need to think more of tangible assets. And so farmland fits within that bucket. We'll call it real assets that are tangible. So timber, farmland, infrastructure, commercial real estate. And they began to be more aggressive in allocating a small portion of their portfolios to real assets. And so the farmland space is actually $4 trillion in the United States. And when you back out livestock inventories, equipment, buildings, and you take out rangeland in the West that's non-irrigated, you get down to about $700 billion of it. That is the investable universe we call, Damien.
Okay. So just so the person, and not that this is huge important from the strategy standpoint, but again, I think it provides a lot of perspective. There's $4 trillion worth of agricultural real estate in the United States of America. This is privately owned, not the Bureau of Land Management kind of thing like that. And then when you backed out pasture, you backed out improvements, like Howard's point, hog buildings, infrastructure,
equipment, inventories. Yep. And states that don't let a corporation or a foreign entity invest in the Minnesota, Missouri, Oklahoma, Kansas would be example states.
Where you're not allowed as U.S. agriculture to even participate in a transaction there because you are a
corporation. In some cases, we represent foreign entities, and there are certain states that have laws against that or state statutes. So when you back that out, you get to around 700 billion of value. And if we use that 2 to 3% turnover rate annually, Damien, then you're at basically $20 billion of real estate that transacts that we can purchase annually, and we're looking about 2 billion. So about 10% of what comes to market, we look at it in some form or fashion, whether it's a flyer that comes in via email or we get intimate on the farm, really taking a deep dive in it. And so back to your original question, why farmland and why now? From that perspective, the institutional perspective, you really can't time farmland. It is a long duration asset. If you do not have at least 10 to 15 year minimum horizon, and I know all the listeners here know this because they're probably generational farmland owners, then we do not want to work with you. It's a waste of their time and our time. But those that have interest typically are long duration, and they're looking at inflation hedge. That's the other key piece of farmland. Keep in mind, it is a tangible asset that grows the commodities that it's our food, fiber, and fuel. And so when there's inflation, we're going to see that trickle back through the products that come off the farmland, and you'll see the farmland value go up with that. And we saw that from 2020 to 22. That really is the rationale of why Iowa, we're looking at the extreme values, but the income piece of it hasn't caught up. And that is the stickiness of farmland, the rental side.
I want to throw it out there. I'm just going to guess Howard Haldeman's been in this business since he was a kid, right? And I'm just going to guess we went through a full 20 years, not even, maybe 30. By the time we got out of college, there was essentially no inflation. Like, it was almost like you would pick up some sort of an article and like there was a shocking level of awe among economists. Is there ever going to be inflation? And I'm sure that Halderman is probably going out to people saying, you should always put part of your investment portfolio into something that's inflation proof. Gold, and hide it in your safe behind your bedroom, or farmland. And these people probably said, inflation's dead. There's never be inflation again. And all of a sudden, I'm guessing about 5 years ago, when the government started printing money and blowing money like it was like water, all of a sudden you had people calling me saying, hey, that thing you used to tell us about inflation? Am I right? All of a sudden, people came to you that you've been trying to tell them for 20 years it's an inflation hedge, and they said, we're not concerned.
You are exactly right. And David's heard me tell this story many a time. We go to a conference in New York every April called Global Ag Investing. And topics like this are discussed at that conference. And we go there to meet with potential investors. So for years, like 2011, 12, 13, 14, etc., 10 years, I said, oh, by the way, you want to invest in farmland because it's an inflation hedge, a 1-to-1 correlation to inflation. Yeah, inflation doesn't matter. Exactly what you said. And then it does. But and David will confirm this, these institutions don't move quickly. We're talking Titanic type movement. And so it wasn't 2020 when they came to that. It was just in the last couple of years. So you kind of got to go through the experience of 2022, which is when farmland went up 40%, 21 and 22, because of inflation. Then looking back, you say, oh gosh, a year or two ago, inflation really had a positive impact for farmland. So maybe I ought to diversify my portfolio a little bit into that so that I got that hedge.
And so they bought it after the hedge had already happened. And so they bought it at the wrong time. David, in good conscience, you had to go to these people and say, hey, Teachers Fund of Arkansas, when I was telling you should be buying this, that was yesterday. You missed the boat. We can't take your money now.
Our teachers didn't miss the boat.
Okay.
Yeah, they were way ahead of it, but we have engaged.
But you had other investors, you had other entities that came to you after the ship had already sailed, and you said, I can't protect you on inflation. You already missed it.
Yeah. And hey, that is what it is. There are other reasons to get into farmland. So although the inflation hedge is a key piece, it is not the only piece, Damian.
And I think, David, the folks that we're talking to these days are buying it as an inflation hedge because they do believe that inflation's probably going to average more than it has.
Yes.
And so that they want to be in a real asset because maybe it's not 10 or 15% inflation, but even if it's 3 or 4, that's materially different. And so as a result, they want to have that hedge. Again, David made a good point. You got these funds that are $20 billion and they have a 1% allocation to farmland. That's 200 million. That's big numbers to you and me. But to them, it's 1%. And they're looking at it and saying, I want to hedge against inflation with that 1%. And maybe they do it with some timber and some other stuff. But that's the mindset.
David, bring it back to the person that's watching this that doesn't have $700 million of farmland under management. Bring it to somebody like me. I own a few hundred acres. I've got a business. I'm making some money. I can't buy a farm every year. I can't buy a farm every month like you guys do. What do I do?
Well, there are small farms that you can buy. Obviously, there are public ways.
Any recommendation you give will be absolutely on the record, and I will hold you accountable based on what the outcomes are.
There is no guarantee to anything in life, Damian. I'll quantify that right now. But there are obviously smaller investments you can make, and I'm guessing that 95% of the people on this and that will listen to this already have a keen interest in farmland or already own farmland. I think the question is, what is the comfortable allocation for their own personal, investments?
They're very
And
likely more than 1%. To Howard's point, you talked about a 60-40. Really, what an institutional investor is doing with you is instead of 60% stock market, 40% bond and corporate, whether they're government or corporate or whatever, they're probably doing 58, 30, 40. They're taking a small part of it. The person that's a Halderman customer is certainly probably more tilted this direction.
yes.
What's the recommendation to those people?
To continue to, I think the long term for farmland, independent of how much capital you want to deploy, is still extremely positive. You look at, they're not making any more of this, Damien. In fact, if you look at the USDA data, farmland is reducing. Acreage in the United States is reducing by 1% to 2% a year, and it's reducing because it's going into commercial real estate or solar panels or other things. And so it is the scarce resource that when a farmer is trying to grow their business, that is gaining farmland, whether you own it or you go and try to lease it, is the scarcest piece of their business model. And so from that standpoint, that gives it a lot of its value proposition going forward, is the scarcity of it. And that's just the farmland piece. As you go west, you also need to think about the irrigation water, because as you go west and you get below 20 inches of rainfall a year, then you need to start adding irrigation. Irrigation is absolutely becoming a scarce resource, and commercial use of water is becoming more and more higher demand, and long term will always outpace agriculture as far as who can own that irrigation water. So those two elements, that's the backbone of farmland, is becoming more and more scarce.
There's a regulatory component to it, which I think is breathing down agriculture's neck when you start talking about the Western Kansases and Eastern Colorado models where they get 8 inches of precipitation and you can't really grow anything with that, which does bode well. So if a person comes to you, Howard Halderman, and says, all right, I'm somewhere between a novice and a David Martin investor. Obviously, you Halderman operates in the Eastern Corn Belt. Do you make the case for the Eastern Corn Belt, or do you say, you know what, I think we're a touch heavy here. I could probably help you deploy your money somewhere that's a little less, where the heat's not as on? What do you tell them?
I think having what David's created at U.S. Agriculture as part of our business has been a super helpful component. So if I have a client today that says, hey, I own 500 acres here in Indiana, you all manage it for me. Probably, and I say this in all seminars, farmland is this. It's a 6 to 8% returning investment year over year. And it's like widgets coming out of the factory.
Factoring in appreciation.
Factoring in appreciation.
Yes.
So when you average the appreciation, it's around 4-5%, and you put your cash yield on top. Right now, you're closer to the 6 probably because the cash yield's a little lower. But that's what it is. If you're investing in farmland to make 15, well, that's not farmland. That's going to be some kind of value add type of strategy. So farmland 6 to 8. Now, if somebody comes to me today, Damien, and they own 500 acres, well, I want to put another $500,000 or $1 million in farmland. Here's the thing to keep in mind: with the appreciation of farmland in the Midwest, $500,000 buys you about 40 acres today of top quality farmland. 40 acres, if it's next to your current holdings, fine, add it on. That's where you ought to put your money, because you're making your base larger. And the farmer always wants to buy the farm next to him. But if you're going to put 500,000 and you're ambivalent as to where it is, well, then maybe you ought to look at some kind of other strategy that is more diversified. Because that 500,000 buying 40 acres that's 50 miles away, 40 acres is a take or leave type of asset for most farmers. I'll rent it, happy to rent it, like to farm it, certainly. But are you going to maximize your rent at 40 acres? No, they can kind of a little more take or leave it. So I would argue that at $500,000, $1 million, they might be better off investing in some kind of commingled strategy. Yeah, there's a couple publicly traded ones that you can invest in. I would definitely look into the metrics on those before I would do it. But you have some ways you can invest in farmland that would get you a more diversified holdings. And I think those kind of strategies might be worth a consideration. So that's kind of the answer I give them is, are you wanting to be definitely right next to what you have?
Yep.
Or do you want to be next to the community where you live? And if so, in fact, David and I talked to a guy last week that he was, well, I would like to hunt, and he works in downtown Chicago. Okay, that defines where he might invest.
Yep.
And he's not really interested in a commingled deal because he wants to have his own asset that he can go out and enjoy, plus it generates some revenue. So it really depends on their goals. But that's what farmland in the Midwest is. It's a 6 to 8% returning an investment, and you got options. You can do it.
And let me dive in on that, because I think we've focused a lot of the discussion on the Midwest or Indiana. A big value proposition of what we bring in that diversified portfolio is a different crop type. And when you get and a relative value, meaning in Indiana, you're going to pay $12,000 to $14,000 an acre for A quality farmland that can grow 230 bushel corn, 250 bushel corn. You can go down to the Delta today and buy an acre for $7,000, and that acre will grow 90% to 95% of the soybean crop that you can in Indiana. And so that's the diversification piece. And you're also diversifying into irrigation water, other crop types. When you go to the Delta, instead of corn and soy being 95% of the crop, they're big into rice. And so there's other areas that bring other crop types that diversifies within the portfolio. So that back to that smile of the U.S., we would say that owning 10 to 15% of California and Washington, Oregon farmland that you can grow a lot of different specialty crops makes sense. When you get good irrigation water resources, that is valuable in itself, even beyond the specialty crops. As you move east into the mountain region, you're getting into potato and sugar beet country that has a different cap rate or income stream than the Midwest. And that's another thing to identify as the Midwest, due to the additional appreciation we've seen the last 2 or 3 years, which is great from an investment standpoint. That just made the incomes compress. And so, capitalization rates today in Indiana, you're down to 2 to 2.5% of cap rates, where your income coming in divided by your valuation is only about 2 to 2.5%. Where when you go down to that, the Delta region or the mountain region, or the Southeast, Florida, Georgia, you can still achieve a 3.5 to 4% capitalization rate. But you are also taking on additional risks when you do that. And that's in the form of irrigation water, aquifers, operators. You don't have near the pool of operators that you have in other areas or in the Midwest. So it is important that you understand where that geographic region, the soils, the water, the operators, the crop types, the markets.
Worse soils, dependence on irrigation, which could have a regulatory or an environmental component to it, depending on where the puck moves politically, I guess we could say. Generally in those places, Delta, I was just there last week, fewer operators, bigger acres. The who's in charge of the transaction changed a little bit when they can take or leave you, to Howard's point. We're going back to, we talked about strategies. First off, strategy, you accept the fact, David, that you're going to get less cap rate, less percentage return in Indiana holdings than you will in Southeast Arkansas.
Yeah, yes, absolutely. And
so why does why does your institutional investor not just come to you and say, why are you investing in Wabash County, Indiana, for crying out loud? You can get double the return down there in Southeast Arkansas, you say.
And I would say that's the value of the service that we bring. We are looking at that $2 billion of real estate a year. And that is what you just brought up. That example is not just stagnant, meaning that is the same example 2 years ago or 4 years ago or 2 years into the future. Agriculture is a very dynamic thing. And Indiana, I anticipate Indiana farmland values will continue to stagnate and possibly soften. And I think we're going to see that income adjust. It's going to have to adjust. We're seeing, increased interest rates. So that income is going to have to adjust moving forward in Indiana. And we've seen that if you go back to 2010 to 2014, we saw this same dynamic where crop prices ran up due to the RFS, or the Renewable Fuel Standard adjustment, and the demand for corn went up and prices went up and farmland went up. And it took really 3 or 4 years from 2014 to 18 for the income streams or the cash rents to really follow and come down. So they typically are very sticky. But we did see that change after 2014.
All right, so we said we're doing success strategies. Go ahead,
Damon. You asked the question. Why not go buy that $7,000 ground in Arkansas for the higher cash yield? When you talk return, it's total return. One of the things that you find in the Delta is their appreciation rates are not quite as high as ours, and so the Midwest is viewed as a blue chip stock, less risk. So a lot less volatility. And when farmland goes up 40%, it's going to go up that or more in the Midwest, and it'll lag in some of these other regions.
Yes.
So while you get a little more cash yield, you are a little more at risk on the appreciation rate. And so again, it's all about diversification for us. And we want to have some of both, because then you get that blended average cash yield, which is better than what you do if you have a one-off farm in Indiana, combined with asset appreciation that you want to see by having assets all over the country.
So going with success strategies for the person that's watching the replay or on here live, and we've got a question. It's not really a question; it's a statement from Tom Vogel. We'll get to. It's just
that's a good one. Yeah, it's good.
You want to go to that now, and then we'll go to the other one.
Sure.
Mr. Vogel says, "Gentlemen," he's talking to me and Howard, David. He says, "Gentlemen." You are leaving some important variables out of your analysis of farm prices versus farm rents. In 2013, using your base number that you talked about, because cash rents has moved by $1, we did not have solar, we did not have wind turbines, we did not have as many cell towers, we did not have the hunting dollars. I might quibble with that. I think that the recreational pressure was as great in 2013 as it is now, but that's your expertise, not mine. And then he talks about we did not have data centers. That's true. And he talks about farmland near a nuclear plant in Northwest Ohio. So I think what he's making the case there for is alternative use, which is one of the things I put on the outline for Mr. Martin. Highest and best use becomes alternative use sometimes. Look at what's happening in Lebanon, Indiana, Howard, right? A bunch of acres are going to get turned into some sort of industrial park, et cetera, which puts pressure on the real estate.
Well, I want to clarify some things here. First of all, we did have wind. Wind started at around 2000 to 2005, honestly, when they came into Benton and White counties here in Indiana. So we started having wind way back then. Didn't have solar. We didn't have as many cell towers, maybe. We did have some. The hunt leasing, we've been doing that for 15, 20 years. So that goes back pre-2013. But he makes a really good point. There are other forms of income for farmland today, and those continue to evolve and develop. And so, yes, while farmland rents are $1 different in 12 years, there are some other opportunities, which is exactly why somebody wants to buy farmland, where otherwise you'd say, well, I'm not going to invest in that because it's just going up in value and I'm not getting any more income. These are reasons why farmland goes up, and they're opportunities, right? So David, how do you evaluate solar, wind, cell towers when you guys look at an investment? Is that a critical part of your investment thesis, or is that a bonus?
Yeah. So, we are looking at that on every property. What is the potential if it is not there? And if it is there, what is the duration? What is the income stream? And so we are absolutely, love to find bare farms that are within a mile or a half a mile of a transmission line, because you know what that means, right? Solar, I think, is here to stay. I don't see that changing. I think we're gonna, as time goes on, more and more dependence on solar, and it will have to be nearby the transmission lines from a farmland standpoint.
And it's been greatly accepted. I mean, there's no people complaining. There's no debates about it. Everybody loves solar. Just go out to the country, David. I realize you work out of Carmel, but
Are you in Arizona right now, Damien?
It's all you. I swear, if you could drive down Main Street in any of these Midwest towns and just say I'm pro solar, and somebody would start throwing rocks at you. It's probably as I'd say it's as big of a hot button as Howard for our age people. It's like worse than like probably what happened with wildcat well drilling back in the when the oil boom was going on. It's got people like insane.
Well,
it is polarizing, but it is still an alternative use that is legitimate, Damien. And we've probably seen approaching 20% of our land. Someone has engaged us to discuss solar optionality. What we found, and that's probably going over the last 5 to 6 years,
Yep.
we found a really poor success rate on those options, meaning they're not turning into solar at any type of high frequency. So we do look for it. It is a small piece of the value proposition from our standpoint. I'd say less than 5% of our income is coming from an alternative use like that.
Yeah.
But it is still a part of the story. Tom nailed it. It is still something that's out there. I do want to make the point because I think it's easy to talk about solar and wind and other income and lose sight of what really the driver of value for farmland is, and that is the increasing yield potential, crop yield potential of an acre of Indiana, Arkansas, Georgia farmland. Every year, corn production is growing, approaching 2% a year as far as yield potential per acre in the United States.
Yeah.
That is just adding more bushels to that farm, and the landowner, as everyone knows, accrues some value in that. About 30 to 40% of that accrues back to the value of the farmland, and so that's really the exciting thing that we have as we look at the technology for row crop farmland out in front of us and the ability to increase yields, soybean yields, rice, corn, and how that impacts the value of farmland, whether it's Indiana, California, Idaho. That's really exciting. And that's the real story there is the increased, income potential on from the farmland standpoint.
Are you okay? Strategies for success for anybody. You're still actively buying because the money's coming in, right? The teacher's pension fund, the firefighters fund, whatever it is, the family office, they've got money to deploy. To somebody that's not in that, timing it can be a tough deal. Buying or selling. Howard, you go first. I want to hear from the institutional investor approach. Should you be a buyer or seller right now?
You look at farmland appreciated rapidly in 21 and 22. And when you adjust real values, take inflation out of it, we're below where we were at the all-time high.
Yep.
I would be active in the farmland acquisition market at all times if I was in David Martin's shoes, because he has the ability to look across the United States. Yep. And the beauty of it is he can say, right now the Midwest is still kind of toppy and cash yields aren't all that high, but there are other places where we can do a little better right now.
David's more in a dollar cost averaging, as they used to teach you.
Yes.
Every 2 weeks, put money into a mutual fund or index account or something like that. The person that might be on this call isn't necessarily in a dollar cost averaging position. And so they were going to say, yeah, I can't quite do that. And of course, every situation is different. Grandma dies, something has to happen on the home front, whatever, but buy or sell?
I'm always a buyer because it's a long-term hold. Here's the choice. If this is money you're going to need for some other use in 5 years, what did David say earlier? If you're not willing to hold it for 15, don't do it. Yeah. So if you have some other use in 5 years, you better not invest in farmland because you could see a decline over the next 5 years. Yeah. But here's the history. If you put $1 in farmland in 1930 and $1 in the stock market in 1930 and run them out till today, they're pretty darn similar investment numbers. And they're the two best investments in the country, better than all other asset classes. So over the long term, farmland delivers 6 to 8% returns. Yeah. I wouldn't put all my eggs in the basket. I don't personally. I have a lot in farmland, but it's a much higher percentage than one. But it is something that somebody ought to be diversified into. And I would argue that when you have the right opportunity that fits your goals, you ought to buy.
Okay, so I'll go with another one. By the way, we do have another. It's a comment, not a question from Trent. Trent, we appreciate that. Obviously, we don't get into the debate part of it, but yes, solar's not self-sustaining without government subsidies. I think we probably all know that obviously it was heavily incentivized through Inflation Reduction Act and some of the other policies. I think the bigger part here is look where the puck is going. To David's point, he believes that the political support somehow is still going to be retained, which means it's going to be a reality, I think, is the issue there. We're not getting into the debate, but I know what you're saying, David. Basically, you're saying the reality is there's going to be solar in some fashion.
Yes.
And therefore, it puts a different demand set on the acres.
Yeah, absolutely. It's a renewable resource. It will be some portion of our electric, production. Absolutely going forward. Hey, and I didn't get to answer the question. I'm a buyer, Damian. We're in the market all the time.
With somebody else's money, there's no risk to you. You just go out there and get someone else's money.
But I'm doing a public service, Damian, because you look at the fundamentals of farmland and world population and the movement into the middle class throughout the world and protein consumption, all of those factors and the scarcity of farmland. It paints a very robust picture to own a portfolio of diversified U.S. farmland, some portion of your portfolio, 1% to 5%, whether it's today or 5 years ago or 5 years in the future.
Let's go with the kind of a spinoff of Trent's comment. And I put this in the outline that I sent you, and I'm not in any way judging. It's just a reality. If we're talking about a United States Department of Agriculture and the United States government that does value food security and understands that food policy involves farm policy. Look at the farm bill. It's essentially not really a farm bill. It's a food bill and whatnot. Can you make the case, Howard, that if a person comes to you with $1 or $1 million, why they should put in there is it's not as really scary and risky as one might think, because in general, there's a level of backstopping done through government policy that backs a strong ag sector, which therefore props up the land market.
And you said it very well. Historically speaking, the United States Farm Bill is about food security. It's about a low price of food today. And the United States, by far and away, we as citizens pay the least amount per dollar earned for food than anyone else in the globe. And I think the federal government back in the early days realized that food was about self-sustainability and the ability to feed the country at large. Today, we're feeding the globe. Our farmers here in Indiana are sending food all over the world. And that is a service, as David said, that we love being a part of. Part of agriculture is that taking a renewable resource, a crop grown every year, and the ability to have it feed the world, have it fuel the world, whatever the use is, and what that landowner chooses to do. We haven't delved into private property rights. I am an advocate for private property rights. And if somebody has an opportunity to do solar and they want to, and it doesn't harm the neighbor, they ought to have that opportunity, right? Now, you got a lot of jurisdictions that can choose to do whatever they wish. And that's up to those citizens in those locations. But you think about investing in agriculture, it is backstopped by global demand for food, fuel, and fiber. And it's always going to be that. So we had this call last Friday, and part of the discussion with this guy was about wanting to buy a hunting property in Northwest Indiana. Okay. But the bigger part of it was he had some clients that had come to him and said, hey, we want to be in farmland because it's a real asset and it doesn't go anywhere. It's going to be there and it's going to continue to generate returns because it's producing something that every human in the world needs. And I think when you look at investing in farmland, that is that baseline and will always be there and make it an appealing asset. Now, certainly the prices of corn and soybeans can go up and down. They can for all proteins, beef, pork, chicken. So you're always going to have cyclical natures of these things. But over the long term, the reason that you see that it perform equal with the stock market is because of the ability to enhance production with technology over time, combined with global growth in population and demand for food and higher value food. And that's what we have the ability to produce. The U.S. farmer is the best in the world at that. We have the best technology, the best patent protection. I invest in the U.S. because of all those themes.
And also there's a stability factor that we,
Yes.
even despite some peaceful protests in various jurisdictions, we're still pretty stable. All right, I'm going to do a thing where I'm going to close out with our friend David Martin here. And okay, I'm just the guy, like probably many of Halderman customers, that own some acres, and it's not my full-time job. And I'm thinking like that. And I'm talking to the institutional guy, kind of like the investor that's talking to the investment banker. You've got a different breadth, but also fundamentals, as we opened up with. Warren Buffett's investing principles and the person on the street really should be much the same. Do you visit the cash rent rates with your tenants, all $700 million worth of assets every year? Is it an annual thing looking at cash rent rates?
Most of our leases are going to be 2 to 3 years in duration, Damien, to give that farmer the ability, the runway to make decisions that are best for the farm. So that is already set. That doesn't mean we're not talking about cash rent, even when there's already a set cash rent. We are very sympathetic to that subject, because if they are not profitable, we can't do what we're doing. So
do you use a professional management on all $700 million with your acres, an entity like Halderman or Halderman?
Yes. Highly recommend.
Every acre is professionally managed.
Yes. Every acre is professionally managed. Absolutely.
How do you look at doing asset improvements? There's the need. This field over here's got water on it. We better figure out how to drain it. How a person, whether they own 600 acres or the amount of acres that you have, how do you look at asset improvement?
Yeah, I think that is the piece of this puzzle that people don't fully understand is we work with family farms that are capital constrained. They are limited with what the capital they generate each year and what they can do with it. We represent capital that wants to deploy in farmland. What a great match, right? And so when a farmer comes to us and says, hey, I want to buy my neighbor's farm. I've farmed it for 30 years. I don't have the capital to buy it. Would you be interested in buying it, leasing it to me? And by the way, I'd love to tile that. Would you be willing to make the investment in tile? And I believe I can get 15 bushel more out of that farm than in its current state. We are absolutely looking for those type of win-win relationships where we can buy a farm or take an existing farm and deploy capital into it, whether it's tile, where it's adding a grain bin for harvest convenience, whether it's cleaning out waterways. The sky's limitless when you start thinking about capital improvement, when you start thinking about 14 different states and different weather patterns and different soil types. So we love that.
This is supposed to be rapid fire, but I appreciate it. Okay, so I want to go to this also. One of our things, the one thing I love, that what you just talked about, asset improvement and farmability, et cetera, et cetera. It was one of our first ones we did when I started joining the Halderman webinars, the Maximize Your Farmland series. And Howard talked about WAPI score that had no reason to be different from one farm to the next because they were almost identical soil types, climatological purposes, et cetera, et cetera. Reputation. And what helps reputation is what you just talked about, Howard. I think that was the one thing I took away from it is don't maintain your asset, and it then upholds a reputation, which then comes out in the marketplace. So that's a strategy that I've taken from you from a year and a half ago on this.
Well, and that's exactly right. What David's talking about, he does that on the front end. So we look at an asset at the very beginning and say, not only are we going to spend $5 million on the asset, but is there another investment we need to make in irrigation or drainage or cleanup or whatever to enhance that operation? Yeah. And then that's the pro forma we build for the client, is that all-in investment. Now, that doesn't mean other stuff doesn't come up over time, and we make more investments, CapEx kind of expenditures. But you're exactly right. Reputation is key. And our goal on any farm we manage at Halderman or at U.S. Agriculture is to have it be the best farm it can be. We can't change soil types. We can't change rainfall. There's some things we can't control, but we can certainly put it in a position where it's the best asset it can be. And that, I think, is our obligation as a fiduciary for the client, is to try to maximize what that asset can be and therefore enhance the overall value of the property long term.
David, what I didn't tell you about that is that he got in my head so much about this that I stuck $65,000 worth of drainage tile in this field behind my house, and I ran out and started mowing my side ditches religiously to the point that I'm taking away from my actual time at my desk where I should be making a living. So anyway, it's a different story altogether. Last question to wrap up the farmland investment success strategies in a down or any ag economy from our expert. Anything that I didn't ask you, any piece of advice, the person, again, maybe they want to invest with you. Maybe they are in charge of the family office purse strings, or maybe they just want to buy that chunk of ground. What's the last thought?
Yeah, I know. I appreciate being on here and the ability to interact with Howard and you. I want to drive home that, hey, the Halderman group of companies, and we're partially owned by Howard, whether it's large institutional capital or small farmland investment that needs professional farm management. We, U.S. Agriculture and Halderman, are really a trusted resource to turn to. You can reach me. You can look at our website and figure out how to contact us if you have an interest in selling or working with us from a farming standpoint. That is the really thing that we are. We are a trusted partner. We work with over 400,000 state pensioners. So that's the kind of trust that we've developed in this space, that we're having state retirees that have voted to work with us and invest in farmland.
If they want to find you, they go to
usagriculture.com. It's us-agriculture.com.
usagriculture.com. His name's David Martin, part of the best class of Purdue 1992. We're going to probably be doing this again. Howard, September?
September. Exactly.
We'll do another installment of the Maximize Your Farmland Investment series from the good folks at Halderman, and I appreciate you being here. I'm just the help. These two are the experts. So anyway, check out David Martin. Also, you can follow him on LinkedIn, and you can find him at usagriculture.com. And if you want to learn more and how Halderman can help you, where do they go, Mr. Howard Halderman? They go to
Halderman.com.
Halderman.com.
Simple enough.
Remember, these are always interactive. If somehow you think of a question that you didn't quite type in here, you can reach out to the folks at Halderman. And remember also, all of these are on, you go to their website and you go under, I think it says under other resources, and you click on it and it says videos. And not only these videos are on there, but also a few other of the interviews that Howard's given in his time around the country. I saw some other media on there. So till next time, thanks so much for being here. My name is Damian Mason, producer of the Business of Agriculture show, and I really appreciate you making me a part of this. I learned a lot.
Thank you, everyone.
Thank you. See ya. Bye-bye.
Till next time.